Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, October 4th, 2018. We'll do this one pretty quick since there's not a lot of this third video today on the market update, and of course a lot of posts in the trading room. But this one is, we'll start out here with the NQ 60-minute charts, and again, if you didn't see the last video, you might want to watch that one or catch up. But I'll tell you where we were. We were down big. In fact, yeah, we were right about here. If I remember, I added this level during that video about 74.95. Saying, ultimately I favored a little bounce here, a little reaction somewhere on that area. We fell quite a bit below it, but then did snap back. You can see here, I'd have to zoom in a little. So we came back above that level. And as I said, shorting, at that point, if you weren't already short, if you didn't position up here or here on the back test and hold on, or on the breakdown here, there were a lot of opportunities recently, but this was not the most objective shorting entry then. But we did get a bounce, and here's the thing. I said I think it would be a small bounce, and I still do. But you got to keep in mind, again, if you were trading today during the day, that when we look at QQQ, this is just a 1-minute chart, a little downtrend line, some divergence, that identified that little pop late day. But here's where we closed yesterday, this yellow line. So at the lows today, QQQ was down 2.6%. And that's a big move for QQQ. I've traded many years. I've seen much bigger moves in a single day, but rarely do they get that much bigger than that without any, number one, without there already being a downtrend, and during that period of a correction that's already well underway and starting to become recognized. That's what I call the point of recognition, or the WTF moment for the longs and bulls, where they realize dips aren't working anymore, and all of a sudden support level after support level gets shattered through. So again, in the right market, a 2.6% drop on QQQ could certainly be built upon, but we're there's still some support levels. The long-term trend indicators are all bullish, and we only took out some mostly minor uptrend lines today. Again, nothing primary. So my point is, you don't short a market if you're not already short that's down, or at least QQQ down 2.6%. But as I said, I think the bounce would be fleeting, and I wouldn't be surprised if it's over now. I'm trying to draw a divergence line on this 1-minute chart. Grab that. There we go. There's a little divergence. So here's our bounce. We bounced off the lows about 0.85%, respectable bounce. But remember, QQQ still closed down 1.92, almost 2% today. So let's see how that looks. Let's just walk out on the time frames here. We'll go to a 60-minute chart. And here's that level I was highlighting, that minor uptrend line that I talked about. I think when I did the video, we were coming right up to it. And I had mentioned maybe an intraday or even an intra-week break of that line level, but to close back on it. And that's what we did today. So you can see what happened. There was a lot of downward momentum. I call that a momentum-fueled overshoot. We shot through that support level, expecting a reaction around there. We got it. We came a little bit below. There's a kickback rally. I could certainly see the possibility of more, but not much more. I think at this point, any bounce, as long as it does not come much above this 184.86 level, maybe even give you up here. Yeah, call it about 185, give or take. And look at the bottom of today's gap. That's a good technical level to use. Here's today's gap, this gap right here. So this first 60-minute candle, the top of that, that would be significant resistance. So I'll leave that other line on there for now. There's also reactions along there. So if you are short or you're looking to get short, I'll say it this way. I think any bounce from pretty much here, this is probably my minimum expectation of what I was looking for today, all the way up to that level, but not above. If we go much above there, even if we backfill that gap, I wouldn't be so hot about that. I don't think we're going to get that far. If you're waiting for that, great if you get it. Maybe, assuming that we don't just blast on through. This is just one big down day. But again, if it was a down day randomly out of the blue and it didn't have all the developments I've been talking about recently, I wouldn't put a very heavy weighting into it. So that's that. So you can look at it this way. Basically a bounce back to resistance. Yeah, we closed a hair above it. And again, when we look at the daily chart, This is the same line. I haven't modified it since that last video. It captures the bottom of those candles well, and this is what we call a stick save. You can see the little candlestick shadow down there, the tail, and boom, park that candle right back up on support. So there's your next sell signal. You're going to take out, really, if we take out today's lows, that's where things should really start. We should start getting a waterfall sell-off, but I think it's preferable, and this is just my trading style. You're going to add to or go back into a short position you might have closed at the lows today to lock in some profits. I would prefer to short on a bounce and then stop out not too far above that gap versus waiting for that. You get a much better entry, and you could, split the difference. Short on a bounce, short, in after hours. If you're an NQ trader, you can watch it tonight. Maybe you get a lift up there. So take a partial short there, and then add if and when today's lows get taken out. That'd be another option. And of course, while we're on the daily time frame, let's not forget the bigger picture. This most recent divergent high, these long-standing negative divergences that have been building. We had divergences early in the year around those corrections, 60-minute divergence on that first one, daily divergence on the second one, and we have some pretty long-standing and building divergences now. So there it is. Like I said, because of everything, the breakdown, the back test, and now SPY is starting to join the party, which is what I was waiting for. Again, I favor a move down here to at least 178-ish level, and quite likely this longer term trend line here that comes in, gosh, I think that's off the early 2016 lows there. Daily or the weekly chart, we should note this right now that we have this minor uptrend line off the early April 2016 lows right here, and this is probably the same one I was just showing you on the 60-minute chart. But on a weekly chart, remember the only thing that matters are weekly candlestick closes if you're trading or using technical analysis on this time frame. Intra-week breaks of support are common; they're the norm. You had one here. That's why you have that green, the shadow on the candle down below the tail. You also have it here on this red doji candle. You had it last week, but a green candle means we printed and closed back above there, and so do those bodies right there. So what am I getting at? Well, today's Thursday. We're well below that level now. Barring a stick save into the close tomorrow on Friday, we'll print a weekly candlestick close. And if we have another red day tomorrow, we're going to have a bearish engulfing candle. And bearish engulfing candles, I've talked about this on the site recently and on and off over the years, they mean very little bullish and bearish engulfing candles when they come during a trend. What you want to look for at the bottom of a prolonged downtrend is a bullish engulfing candle. That's a big green candle that engulfs at least the previous day's, the body of the previous day's candle. And a bearish engulfing candle, you want to see the body of this candle as of the close tomorrow. Again, that'll be Friday when we print the finalize this candle, I should say. If we're below that, the body of the candle here in the previous day, and we'll have engulfed those other two. So we have the potential. Just look at it this way, and again, it's only something we're on watch for, but I like these. They're pretty high probability candles when we get them, especially, again, filter them out. Don't jump on every bearish engulfing you see, but when it comes after a prolonged uptrend, and this is right off the highs. So if we got that, you're going to engulf, 1, 2, 3, 4, yeah, we might. Yeah, we're right about there. 5, potentially, yeah, a whole lot. And these are weeks, so we're talking a couple. We could have a couple months of candles of gains engulfed. So what does that mean? A bearish engulfing candle? Well, it just like I said, you engulfed or wiped out in just a brief period of time. In 1 week, you can wipe out months of gains, and it's quite bearish because everybody that bought here for the last couple months, again, if that happens, and depends how far down we go, they're now underwater in just 1 week. What took them months to build. And so in technical analysis, bearish. They want out. They bought. They're now underwater. Stops are being hit. There's a lot of reasons for it. And then you want to see follow up the next week with another red candle that helps to confirm a bearish engulfing candle and sharply increase the odds that we're not just looking at a little pullback correction here. We're looking at maybe a much deeper correction because of the bearish nature of this happening if it does again on the weekly time frame. So something to watch and worth pointing out. And then remember, we have this primary uptrend line off the early 2015 lows, well defined. Last time we had a comparable trend line in length and slope and everything else, virtually equal slope, roughly an equal length. And here's what happens. when you break down, especially on a weekly closing basis, things happen quick. This was a 26% drop on QQQ from highs to lows. A lot of that had a little, some of that was a flash crash on the ETF. The NDX didn't fall that much, but it fell almost 20%. And you can see the bulk of that happened in just 2 weeks once trendline support gave way. So all I'm trying to say, and I'm not using scare tactics or anything, but be on guard and be ready to fire off because when you're in a bull market, it's everything's in slow motion. You have plenty of time to buy the dips. You can even be wrong and miss out and buy the highs, and you'll get bailed out. But during corrections, you have to be fast, not only on your entries. You wait too long, most of the move's over. Even more importantly, you can't stay too late at the party because reversals are very fast, especially, well, even in a bear market, but especially during a bull market. So you got to have your ducks in a row, your trading plan, your price targets, plan A, plan B, plan C, etc. And we'll just walk it backwards now from the weekly chart on SPY. Here's your bull market uptrend line off the March 2009 lows. Very well-defined trend line comes in here. I know it gets a little sloppy as I zoom in now, but that white trend line, this is the primary bull market uptrend line off the March 2009 lows. Uh, During that volatility we had early in the year, there were a couple weekly stick saves. See these little tails hanging down, the red tails? Means we pierced that trend line, a very important trend line. We tested it here, successful test. Another successful test. We closed right on it with that big red candle. Another test. Another test. Intra-week break, but we closed back on it. Test, test, test. So you can see it is. This is not some random line. To me, this is an important line. Now we're still comfortably above it for the time being, but as I always say, stocks tend to fall a lot faster than they rise. We're only 3.5% or so above it, so that could be taken out technically in a day. Not saying it will, but that's possible. So, what happens tomorrow? If we have a pretty ugly close into the close tomorrow, big weekly close, you'll also be looking at a potential bearish engulfing candle here on SPY. We could hit that trend line next week, and it's possible to go down on through it. And again, it's these divergences, this waning momentum that makes, bearish engulfing candle here different from any other one here at that time when we didn't have. We had just come off a period of about 2 years of sideways consolidation, worked off the overbought conditions, excessive bullishness, and that set the stage for a nice rally. So therefore, you get a, bearish engulfing here. It's not a big deal. Dip gets bought. And that's the other thing about dip buying. It's like, if you're familiar with Pavlovian conditioning, Pavlov, he did an experiment years back with dogs, and he was the one who he rang the bell, or actually was, I think, a metronome, if I remember right, a little device that makes clicking sounds, but we'll call it a bell for all intents and purposes. So he's the one that rang the bell every time he would feed the dogs, and they would start to salivate because they had their food there, and they'd smell their food, eat their food, and eventually you take the food away, you ring the bell, they still salivate. So you had a conditioned stimulus, which is the bell, equals a conditioned response. That's salivation. You remember that if you took psychology classes in high school or college. So what I'm getting at, I know it sounds like I'm going off on a tangent, but that's what happens to the dip buyers. They're conditioned, just like Pavlov's dogs, to buy the dips because they're rewarded. And it works until it doesn't work. And this is what makes for sharp corrections. This is why you have these waterfall type sell-offs. They buy the dip like they did before. Oh, okay, it goes down a little more, they buy the dip again. All of a sudden they realize it doesn't work anymore. And in Pavlovian conditioning, originally it was assumed that it took repetition. You had to ring the bell quite a bit as you fed the dogs before you'd get that conditioned response to salivation. But then they learned that it's much more effective, and you can learn it even in one single instance. You can, teach an animal or a human with negative reinforcement. So in other words, if you've been feeding the dogs, ringing the bell, and they come out next time you ring the bell and you beat the dog, it doesn't take as many beatings as it does give him feedings when he hears that bell to all of a sudden stop salivating and then start running the other way or being nervous. So, and that's, I don't know, that's my analogy, and that's, I think, how these corrections happen. And so keep that in mind. And so what I'm getting at is dip buyers bought the dip today. They might have saw that, noticed that, the QQQ was way down, like I said, pretty much at its limit without any major market moving headlines. This was technically induced, and so they stepped in, they bought the dips. Technical traders could have watched this divergent low on the 1 minute chart, a little breakdown, and then that move up. But if this doesn't continue, if we don't go on and take out, like I said, the top of that gap, the top of yesterday's, well, let's just say yesterday's close, that would be the top of today's gap. Here's today's gap. And we go down and we undercut tomorrow's lows, that's where the selling usually starts to accelerate. That's what I call the WTF moment for the dip buyers. They're saying, what the is going on here? This isn't working anymore. I got to get the hell out of Dodge. And then stops start getting hit. You get the shorts that didn't want to short before because they were also conditioned, with the conditioned stimulus that stop shorting the market. You're going to get burned. You're going to get burned. So it keeps a lot of shorts out at bay. But once they see, it's like sharks in the water. They smell blood. So the shorts pile in. That leads to additional selling, and in addition to the longs getting out and having their stops hit. So, all right, that's a lot. And I'm just telling you how my experience of how the market works, and I think the underpinnings work, and we'll see. So it's all contingent on yesterday or today's lows being taken out. And remember, we're not too far above that 180-ish support, but I do think, and I've seen this often, if these, the lows get taken out, we have another bad day tomorrow, especially a big bad day. It is not unusual to see those earliest support levels get shattered and taken out as if they're not even there. Again, that's where the dip buyers will be looking to step in. That's where I would, if I was, if I thought the market was going to go to new highs this next week, and of course it may, but I don't think so. And this is where I'd be buying. Heck, I would have bought today with the QQQ down 2.6%. I would have been going long more than just for a bounce trade, but for swing trade up. And here's that ES chart I've been highlighting so much recently with the trend line off the late June lows. Well-defined trend line. There was our sell signal last night. I posted that in the trading room. Looked like the first, been waiting for this one to crack. It was early, but we also saw NQ breaking support. And then there's that secondary minor support level that was taken out. And not by coincidence, look where we closed today. We had we got pretty extended on the SPY and then snap back to close pretty much right on former support. Now, keep in mind, support once broken becomes resistance. So unless ES can get over there back above that level tonight, you could be looking at a reversal, possibly a move happens overnight with a gap down. But keep that in mind tomorrow. Whatever happens, if you're not a futures trader, get up, check the SPY or QQQ on pre-market, or get a quote on the futures. Because if we gap down here to about 2870, that's a 2870.50, that's my first target, and I expect a decent reaction there. It's pretty good support. If that level happens to go, if things get really ugly, you can see I have some additional levels and potential targets here. And I do think there's a good shot we come on down before all is said and done, where I might look to position long for a swing trade. I'm an active trade. I often, if the intraday charts confirm, I'll gain bounces off these levels, reverse a short to a long, reshort here, get back for the for the breakdown. But here's a level about 2796 that based on the scope of this pattern and everything else. But keep in mind, I will align that with trend lines on SPY, daily, weekly trend lines. I'll align it with support on QQQ. What I mean by that, let's just say I'm right, and ES is cooking on the way down here, and everything looks good, like this is going to hit. But right here at this point, NQ or QQQ hits a key support level. What's going to happen is that will most likely stop ES. The buying will step in. They'll start buying NQ. So many of the components, especially the top components of the Nasdaq 100, are also top components of the S&P 500. And when the algos flip the switch to buy, high frequency trading, the algos say it's time to buy. The computers take over. That you get a reversal. That's why I won't trade any one of these index ETFs in a vacuum. I'll watch the other ones. But if everything's in alignment, usually you'll see that SPY coming down or ES coming down to support right around the same time QQQ is. And those are the times that, and that's somewhere where I might be looking to go long again, if and when we get there. First things first, of course. Now, I showed you SPY and QQQ comfortably above their long-term trend lines, but check out IWM, this yellow trend line. Let's go to weekly chart here. Small caps are walking the line right now. This is a trend line off the early 2016 lows. It's a pretty important trend line. It's not the bull market uptrend line, but you can see they closed. I have two lines in close proximity. Let me move this one for you so you can see. This is my benefit of the doubt trend line, or the lower two. This one fits pretty well. A lot of reactions on this white trend line. We broke there today. You get the 200 or 40-week moving average. That's the same as a 200-day just below. That may come into play as support. And then this is, again, what I call the benefit of the doubt trend line, because what I'm doing is I'm capturing, there's a candlestick body, tail right there and another tail right there, and then today's close. So if I put that yellow line there, it pretty much says IWM has very little downside to go without making a pretty important breakdown, taking out that 40-week moving average, taking out the lower of the two trend lines here. Again, the divergence in place says that we will likely take those trend lines out, whether it happens tomorrow or this week or next or in 3-4 weeks from now. But just like we had divergence here, followed by one of the biggest drops in years in IWM, small caps fell, and it's a rough estimate about 25% there. Just like we had negative divergence on the weekly chart here, and the small caps fell about 30 or so percent, 32% right there. There's not a single thing I see in the charts. In fact, I see a lot in the charts that tell me this time won't be any different. Sentiment's extreme, valuations are extreme, short interest is low. Bulls are getting, cocky, starting to talk about crazy numbers. The market's going to go up forever. So you got that. So whether it's the end of the bull market or not, I don't know. Who knows? There's plenty of, but even a swing trader, I'm looking for a 20-30% correction, because even once the next bear market starts, I don't short and hold to the bottom. I game and I love trading. That last bear market, I did extremely well in both the down, the sell-offs, the major legs down, and then the counter trend rallies. And I love the counter trend rallies because, just as I say, stocks tend to fall a lot faster than they rise. Nothing is more beautiful than a bear market rally. You have so much short interest, and the charts do the same thing in reverse. They set up, you have trend lines, bullish patterns, you get in, and the snapback rallies are so quick because you have buyers stepping in plus all the shorts covering. So again, like I said, there'll be plenty of opportunities on the long and short side. And if this bull market continues for another year or two, keep doing this. Keep waiting for the swing short setups. If I see an objective long entry to put on a long-term trade in any of the index funds, I will. But I can tell you right now, nothing, absolutely nothing in the charts would have me over the next, for the foreseeable future, next month or two, compel me to put on a long on any of the index funds. The risk reward is just awful. It's skewed to the downside now. So I don't care if this market goes up another 20%. It's just nothing that I see in the charts that tell me go ahead, because right now there's still an elevated risk for a quick swoon down. And again, I think there's probably, maybe another week or two of topping action needed before you get those quick swoons down like you had here, but could come out of anywhere. And that's when I talk about the risk reward not being attractive. You don't want to be caught waking up to a gap down of 3% plus in the markets, and you're trapped in there. And you're going to want to wait for a bounce. It's probably going to never come. Then you're down 6%. Then you're down 10%. I don't know. It's just the cycle of things. This is how it usually does work. Longs get trapped at the top, just as shorts get trapped in the bottom, and the reversals are pretty strong. Okay, let's just wrap it up here. Let me give you some focus in on some levels. I already showed you a few. But again, here's what I'm looking at. This is the NQ 60-minute chart. You can see all these divergent highs. This most recent divergent high, then the breakdown and the back test and everything else. And as we zoom in, there was a little minor trend line there. Levels to watch, again, we snap back and we're over that level right there, about, what is that, 75.09, but not by a whole lot. We could turn down here soon. An aggressive trade right now, if you don't have a position, I think you could short NQ right here with a stop, somewhat above, slightly above it. Look for a reversal, fall back down there. If not, you can see this next level I have up here at about 75.77, and it's pretty well defined. So let's just call that the short zone. This is some reactions along the way. So that would be your shorting zone. And if you're bullish, buy the dip. We were down almost 3% today. You should have bought the dip. Again, if you think the market's going to new highs anytime soon, or if we do get, like I said, I'm looking right now for a thrust down here to about the 74.07 level. If we get that, that's a pretty decent support level. Shorts may want to cover to try to game a bounce trade again if SPY, ES, everything else confirms at the time. And longs could certainly go, take a long position there with a stop somewhat below. Just remember when volatility gets spiking and you see these big moves like this, you have what I call momentum fueled overshoots in either direction. So if we do shoot down there tomorrow, maybe we shoot down through it for a little bit, intra-period, maybe even on this a 60-minute candle goes through there, but then closes back above it. So you have to, in my opinion, you have to give yourself a little room in a more controlled market where volatility is not so high. Usually see prices respond and reverse right on, support levels or very close in an orderly market. So food for thought there. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.